Assalamu alaikum friends. Welcome to today's video. So before I start today's lecture, first of all, I want to apologize to all of you for not being active on my channel for a month now. The reason is I was having some personal commitments. For that reason, I couldn't upload videos as I promised that I will be doing. So for this season, for the December session, I'm going to cover the remaining parts of SBR, the lectures. I have to finish two topics from SBR lecture that is pending, which I couldn't cover in the September exam. I'm going to cover it in the December exam. And number two, the questions. Okay. So I hope that the new books have arrived for SBR, the textbook and the revision kit from September 2021 till June 2022. And when I was going through the textbook, there is not much difference with the old textbook. Okay, because the lectures and the questions that I have covered was for September using the previous book, not not the latest book that just arrived. But good news is whatever I have taught as it is, you can use it in your December exam. No change. The only thing is, uh, wherever there are slight changes in the syllabus, that I will cover when I'm doing questions, okay, in my question session. For example, IS 19, employee benefit. Termination benefit has been added, which was not there in the previous syllabus, which I didn't cover. So that I will be covering when I do a question relating to IS 19, inshallah. Okay, so you don't have to fear about it. Okay, and so in my playlist SBR lectures, I have stopped in lecture 64. That was IFRS for SMS. That was my last lecture. I stopped there, and I couldn't cover two topics, very important topics. One is analysis and interpretation. Under this we have different subtopics, okay, that needs to be covered. And the the last topic, that is current issues, I couldn't cover it in the lecture, but I covered it in my revision series for September exam. Okay, so inshallah that I will be covering for the December exam. So these two topics will be added to my playlist. Okay, other than this, lectures of SBR, for example, whether it is IFRS standard or IAS standard, I don't have to upload anything new. You can use it from the playlist for the December 2021 exam. Okay, that's uh, that's an announcement that I want to make. So this two will be added, and the questions also. What happened in the revision kit question is only the order changed, the number changed. Okay, maybe in your new textbook, sorry, revision kit, two more questions are added in question number 1 and 2. They are taking it from the latest past paper, that is 2020 December exam. Okay, so that order has changed. Okay, so those questions I will include. You don't have to worry about it. And whatever the other questions that I have not finished in September exam, I'm going to cover it in December exam. You don't have to worry about it. Okay, so this season I'm again going to go with the SBR since it's not covered fully. Okay, and I'm not going to teach any new subject. The reason I'm making this announcement here is because many of you are asking me for other papers, okay, which is not possible. Okay, inshallah later in future, maybe for March exam and all, I will be doing it. Okay, so I last season I was having this I was having a heavy schedule, right? It was so packed up. I had to do revision series for triple A, then double A, then AFM, then SBR. So this season I want to take a little bit, I want to relax and I want to just go with one subject. Okay, so I'm sorry, I cannot, I apologize that most of you have been keeping this hope from me that I'll be doing, but I will not be able to do it. Okay, maybe the past papers and all, one question maybe I'll be able to solve from SBL or AFM, but other than that, I cannot teach the subject. AFM is already out there. Nothing has changed in AFM, so that's okay. SBL, I cannot teach SBL. Okay, SBL, you yourself can do self-study on that, read it. Yes, but the application part, applying it to the questions and all that, I will show you a demo, but not now. Maybe a month or a later after I'm done with SBR, because my main focus is now SBR. Okay, that's the main focus. So let's start with SBR. Okay, for December exam, this is my first video for December session. Okay, and it's very nice to see all of you after a long time. I think a month I have taken this gap. Okay, I was relaxing and I was also doing something new. Okay, some commitments I had for which I couldn't communicate and I couldn't connect. much. But now the good news is I've started again with my channel with SBR. Okay. So the topic that I've stopped was IFRS for SMS. I've covered all the standard. Now I'm going to start with analysis and interpretation. Okay. And under this, we have many subtopics, and this video is only going to cover the first topic, that is financial ratios. So this video, we are going to cover all the financial ratios important for your SBR. So let's start to the topics that we are going to cover in the upcoming session. This video is only going to focus on the first two. One is introduction to the concept of analysis and interpretation, and second, financial ratios. All financial ratios are covered. The rest, so for each topic, each of this topic that you can see on the list will be covered in separate videos. I didn't include it in one video. Reason, the video becomes too long, and most of the people, they don't like seeing long videos, you must be knowing it. People like short videos. They can consume a lot, they can retain better information in short videos. 10 short videos better than one, combining everything and making one whole video. That's what my observation says, and that's what I've seen the trend. So that's the reason I wanted to make you easy, accessible, and easy to remember. That's why I've divided this into, you can say, 12 separate videos. But the topic is one. All this topic comes under analysis and interpretation. Whether it's your integrated reporting, whether it's your non-financial measure, whether it's your financial ratio, okay, all this comes as a one big topic, one umbrella, that is analysis and interpretation. You use these things to analyze the company, their financial position and performance and all. But they are into separate topics, okay, separate videos. So the topics that we are going to cover is introduction. I'm going to introduce you to the concept of analysis and interpretation, very brief. Financial ratios, that's the main. IAS 33, that is your earnings per share, is also with the financial ratio. We have already covered IAS 33. I'm not going to go into the depth of this. So you have to watch IAS 33 video for the formulas and everything. Impact of policies and statement estimates. This will be in the second video. Okay, upcoming. So policies and estimates, we have went through all this. Okay, that is under IAS 8. Okay, statement of changes in policies and estimates and prior period error, right? Then we have statements of cash flows, IS 7. We have covered this, IS 7, but here we are only going to deal with the analysis part. How are we going to analyze the performance of the company using the statement of cash flows? That's our only aim. Additional performance measures. You must have seen a question in your SBR, the last question, I don't remember, question 3 or 4, where you have been asked additional performance measures. Very important. You cannot omit any of these topics from the list. All this needs to be covered. It's not just the knowledge of your standard IFRS or IAS that you need to pass your SBR. You need this other additional information as well. That's the reason I am teaching you this as well. Okay. Tech companies. Tech companies have a different way to analyze them. Okay. Non-financial performance measure. All this while we were doing financial measure, additional performance measure, now non-financial measure is also important. Impact of ethical, environmental, and social factor, development and sustainability reporting, integrated reporting, and not-for-profit entities. Okay, so these are some tools for analyzing the performance of the company. Now let's start. What is analysis and interpretation, and why do we do this? The main reason is because information is so very important, not just to the shareholders but different stakeholders, to know what's happening in the company, to know where they stand. Okay, so having that information, then they can make a decision about the future. Are they going to hold the shares? Are they going to sell the shares? What are they going to do? Okay, so the reports that we prepare for the stakeholders is very important. So we have to analyze, and interpretation is very important, because without proper interpretation or proper analysis of the information that you are given to the stakeholder, information is useless. Okay, that's why analysis and interpretation is very important. Number 2, this is just introduction. This is for your exams point of view. Examiner will not ask you what is analysis and interpretation. Come on, you don't have to say all this. It's just to make you familiar with this topic before I actually go in depth to the different types of interpretation tools and all. Now, most of the information that you need to interpret the performance of the company is already found in the financial statements. You have your statement of changes in equity, statement of cash flows, what else? Statement of profit and loss and other comprehensive income, statement of financial position. Okay, all this they have the information. Okay, but they are financial information. They're only financial information and at a point in time. Okay, now companies are producing other types of report also, such as integrated reporting, where they try to cover the holistic view of the company. The non-financial factors also taken into account. Okay, to interpret the performance of the company. And so this chapter, this analysis and interpretation, by the way, in your Kaplan textbook, when you see this chapter will be chapter number 22 in your textbook. Okay, so all what is there in your textbook, I have taken it here, but in a simpler way. Because most of you don't like reading textbooks. You don't have time to read all those lengthy sentences and all. So what I have done, I have made it uh, shorter and in a more easy accessible way so that anyone can. You just need to spend maybe 10 minutes to have a understanding of this topic through the video. Of course, when you are reading it takes more time. Okay, that's the reason. So this chapter examines different sources of information available. Okay, when you take information, it's not just from one source. Earlier it was just from your financial statements. Now there are so many other sources. We have environmental report, we have social report, we have integrated report, we have additional performance measure, we have non-financial measure, all those things. We have information from online sources also. For example, your customer review, your customer feedback. Understood? So different source of information and a range of analysis technique. We don't have just one technique. There are multiple techniques that are used to analyze. Okay, that can enable the key user groups to make informed investment decisions. So why are we doing this analysis and all? So that user, whoever is relying on that information, can make informed decisions, informed investment decisions. That's the reason why this analysis and interpretation is so very important. How do we know whether we have to invest in a company or not? You look at the ratios. Ratio is also one way of through which you are analyzing the company's position and performance. There are so many types of ratios which we are going to cover now. Financial ratio. Hence, financial ratio is very important because through this we understand the performance of the company. For example, if I say company A and company B, company A is making a profit 10,000 worth of $10,000. Company B is making a profit of uh, let's say $20,000. Now, looking at this two figure, you would say company B is performing better, right? But what about the size of the company? Maybe the size of the company that B is operating is massively competitive. Out of that, which is making 20,000. But company A is in a less competitive environment, a smaller entity, okay? And in this market and in the industry which he's operating, 10,000 is a big figure. So now your decision changes, right? It's harder to make a judgment, compare the two entities. That's where financial ratios comes into the picture for comparison purpose, whether company A or company B is better. Why? Because financial ratios are in terms of percentages. It's easier to compare when it's in percentages. People understand that this company is making 50% worth of sales, the other one is making 40% worth of sales. It's easy. Your gross profit margin is 10%, here he's making 20%. So you can easily interpret. Hence, there are multiple financial ratios that you need to know and the formulas you need to know by heart. It will not be given to you on your exam formula sheet. Okay. So it is divided into 4 categories according to your textbook. But if you see Google and other textbooks and all, there might be other categories also. Okay. Categories and all does not matter so much, but the ratio, the formulas you need to know and how to calculate you need to know. Okay. So under first type of ratios are known as profitability ratios. Under profitability, we have 3 types of ratio: gross profit margin, operating profit margin, and return on capital employed. You must be familiar with these 3 ratios from your earlier studies, financial reporting or financial accounting. Okay. If you forgot also, it's okay. It's not a big deal because I have included the formula for you. Okay. Then we have second type, which is liquidity and working capital. Under this, it's more about whether how liquid your company is. We have current ratio, that is under liquidity ratio. And for working capital, we have inventory turnover period, receivable collection period, and payable payment period. Okay, I'm sure you must be familiar with these terms. You know what is current ratio, you know what is receivable collection period. So I don't have to explain you in detail what is the meaning of this. If you don't know the meaning of this, you can Google it and check it out. It's very easy. Okay, because you don't have to give the definition in the exam what it is. Okay, just apply the formula and get the answer. And another question students often ask me that when you're calculating ratios, do I have to write the formula? No, you don't have to write the formula in Excel, because in Excel sheet, when you're calculating it, automatically in the formula sheet, when they open it, we can see in the formula that calculations has been performed. For example, for current ratio, I'm writing current asset. In one cell I'm putting current asset, and another cell I'm putting current liability, and on another third cell I'm writing equal to current asset divided by current ratio equals to, no need to write current issue, just write current assets divided by current liability in the third cell. So automatically when I click that cell, I can see which are the two figures that I've taken in the third cell. So you don't have to write current ratio equal to current assets over current liabilities, then again current ratio is equals to this divided by this, then the answer no. So all these three steps you can just eliminate and put it in one step, because Excel has made it at ease for you. Earlier, when we had to write it on a paper, yes, we had to write the formula. Why? Because so that we don't make mistakes, examiner knows from where we have taken the figure. But now, because of Excel, you don't have to do it. Because Excel will, when you click that cell, they can check which formula you have given there. So, so rather than putting everything equating on your own, better to put it in two separate cells. For example, current asset you are putting in one cell, let's say cell A, current liabilities in cell B, and cell C you are taking the division of this two number, A divided by B, cell A divided by cell B. You will get the answer for the current ratio. This is the quickest way and the easier way, so that if you make any mistake later, you just have to change the number in one cell, automatically your answer changes, rather than you individually typing the number, putting in the cell. Let's say your current asset is 2, current liability is current asset is 4,000, current liability is 2,000. So you, rather than writing 4,000 divided by 2,000 in one cell, put current asset in one cell, current liability in second cell, and then the answer. So that let's say later you came to realize no, it was not 2,000, current liability was 200. You just change one digit and automatically your answer changes, because you have put a formula in the third cell. So this saves a lot of time. Not only for this, for any other calculations in SBR, you can use it. Okay. So inventory turnover period receivable, set formulas there, just know the formula and apply the number, that's it. Third type of ratios are long-term financial stability. Okay, your liquidity and long-term financial stability are not the same. Liquidity is usually for the short term. Okay, long term is for the over the long period of time. For example, we have two types of ratios under that: gearing ratio and interest cover. Formula will be given to you in some time. Fourth type of ratio, very important, especially for SBR purpose, is your investor ratio. One is PE ratio, the other one is your earnings per share. Okay, you need, there is a relation between PE ratio and EPS. You need to know both the formula. Okay. Earnings per share, which is also dealt under IS 33. I have previously covered all the formula relating to it. I'm not going to cover it here. So you have to go back to IS 33 and check out, okay, all the details. But here are some, I have summarized the key things that you need to know about IS 33. There are basic EPS. You need to know the formula of basic EPS. Okay, then you need to know the diluted EPS. Then you need to know the bonus issue and right issue, the impact of this four things you need to know under I have covered this four under IS 33. Then now let us go to the starting with our first set of ratio, that is profitability ratio. Before going to any type of ratio, please be very careful, pay attention to this. SBR places less emphasis on the calculation of ratio. So SBR is not about calculating of ratios. It was done in the financial reporting level, in your knowledge level, applied skill level, not in your professional level. In your professional level, you will be given some figures, some ratios, then you have to analyze what is the performance of the company, financial performance or position of the company. Is it good? Is it in a bad light? How is it? Looking at the ratio, maybe sometimes ratios there might be error, you might need to change. So these are the type of work that is expected of you from your SBR, not sitting and just calculating some ratios knowing the formula? No. And not all the ratios will be asked. No, maybe 2 or 3 ratios. Max, maybe 4, up to 4 ratio they can ask in a single question, in a single sitting. Okay. So you have to do not just the calculation part, but the discussion part as well, the explanation part also. Why, if this ratio is decreasing, why is it so? If this is increasing, why is it so? This also I've made it easier for you because some explanations are very common depending on the type of ratios. I have included it here. So this will help you in writing your answer. First is profitability. Under profitability, gross profit margin, the formula is gross profit divided by your revenue into 100% because this is in a terms of percentage. Okay, so in an Excel, when you're putting, you just have to write gross profit margin in one cell and the next column. Okay, you must have written your gross profit and revenue somewhere else. You just have to put it there. That this divide by this. It's better to put gross profit and revenue in a separate cell so that if in case you later came to know that your revenue has changed, your automatically you change the revenue, answer changes. But if you don't want to do this, then put gross profit, the figure, and the figure of the revenue in that cell and then into 100. But the second method is more risky. I'm telling you again. Okay, definitely I will show you a demo of this. Maybe after I finish all the lectures and the in my what is this SBR revision kit solutions. Maybe there I will cover this. Okay, because this type of questions under analysis and interpretation is asked in question 3 or 4. Mostly I think in question number 3, if I'm not mistaken. Okay, but it does not, the question number does not matter so much. Okay, what matter is that you need to know the correct way of doing this type of questions. That's most important. Okay, next we have operating profit margin, but before that, as I told you, calculation is not just enough. Discussion part in SBR is uh, placed more emphasis. In SBR, discussion is needs to be more than the calculation. So focus on your discussion. Okay, if your gross profit margin, you can see it increases from year to year, or if you see it's higher than your mostly they will give you separate years, 3 years or 2 years, or it does not matter. But if your gross profit margin increases, it could be the result of 3 things. Number one, higher selling prices. Maybe your selling prices this year is higher, which increases your gross profit margin. Okay. Second, lower purchase prices. Maybe you are buying in bulk, so you are getting a heavy discount. So because of that, your purchase prices reduces. Third, change in the sales mix, the way you are, selling a product, the price and the quantity, you are changing. And if your gross profit margin reduces, it will be the opposite of this 3 point. Just change. Here it is higher selling price. When it reduces, it will be lower selling price. Here it is lower purchase price. When gross profit margin reduces, it will be higher purchase price. That's it. Just change the word from higher to lower or lower to higher. That's it. Okay. Now let us go to the second type, which is operating profit margin. It is very similar to gross profit margin, but here it is operating profit divided by revenue. Okay. So what does it mean? Many operating costs are fixed. Okay. That means it does not increase or decrease with the revenue. Fixed costs does not uh, increase or decrease. It remains fixed only, unlike variable cost. So that means operating profit margin will be more volatile. Volatile means it will be changing more. Okay, rather than the gross profit margin. Gross profit margin, it almost remains similar. The changes from year to year, but operating profit margin changes very drastically. That change is very drastic. Volatility is more. Now, be aware that many operating costs, such as depreciation and impairment losses. Okay, this type of cost are what? Depreciation. You deduct depreciation and impairment losses. This comes under operating cost. You deduct operating cost from gross profit, then only you get operating profit, right? So depreciation and impairment losses and amortization, these are some examples of operating costs which you deduct. So this costs, okay, they are heavily reliant on management judgment. These are not some objective losses. You cannot verify this with your cash flow. Okay, I have paid this much of cash, or this is the exact cost. I know. No, you are using management judgment over there. These are estimates. Okay, so this may hinder the ability to compare the operating profit. So because you are using estimate here, one company might be using a straight line method, The other company might be using reducing balance method. It's hard to compare using this method, operating profit margin. Understanding these are some limitations. You should know the limitations also of a ratio and the advantages also to write in order to write better. Okay. Definitely, I have already told very small brief points. This is from your textbook only. All whatever is there in your textbook, I've covered here. Okay. The only way is my presentation I've changed. Okay. So it does not look very boring. That's the only difference you will get. But if you want to find more points, you have to Google it out, or you might have to, talk to your friends, get some notes. Okay. But what I would suggest is you don't need all this extra notes and everything to pass SBR or any paper, in fact, in ACCA, because I have never used it. Okay, and I passed with great, very high marks. I'm not boosting myself. I'm not being proud of myself that I've achieved this, but I'm just telling you the reality. Okay, that reality check you need to have. What you need to focus on and what are the additional things. If you have time, it's good. Go through the additional, but you should not waste time going over additional stuff and forgetting the basic necessary things. Okay, because the more you go through, the more confused you will be. You understanding what I mean? So I don't want you to panic or overdo or stress yourself with so much of information, because we see information is overloaded nowadays. Okay. So rather than going through 2, 3 separate books and finding out which one is the best, I would say whether BPP or Kaplan, just choose one book, stick with it, and just learn your concept. That's it. You should have a sound understanding of this. You should know the formula correctly. You should know the application of this. That's it. That's all. That's it. Only this matters. That's it. And also time management. You have to manage your time. Only these 3 things you need: calculation, discussion, and time management. Okay. Now, return on capital employed. This is very, very important, because most of the SBR exam, if ratios has ever come up, this ratio, they always try to include this ratio, return on capital employed. Here it is operating profit. Please be careful. Operating profit it is, okay? Divide by capital employed into 100%. So capital employed, how do you get capital employed? You will get from a statement of financial position if they have given to you. Equity plus interest bearing finance. That means your equity plus your debt. That is your capital employed. Equity plus long-term debt. That is the meaning of interest bearing finance. Because long-term loans and all, they have interest on it, no? That's the meaning of it. It's not equity plus interest. It is equity plus long-term loans. Okay, equity means your share capital and your reserves, share premium you add, and your long-term loans. That will give you your capital employed. Okay. So ROCE, this measures how efficiently you are using the resource. For example, the operating profit that you're having. Okay. From the capital employed, from both equity and debt. How much are you getting the return on that equity and debt that you're investing? That is the meaning of return on capital employed. And this should be compared to previous year figure, the target return on capital employed, return on capital employed of competitors, and cost of borrowing. They will give you these things, okay? If you have to calculate, sometimes you have to calculate for 2 separate years. So make it in 2 separate column and do it at the same time only, one after the other. Don't finish one whole year and then again start the second. No. When you're doing, let's say for 2008 and 9, when you're doing for 2008, simultaneously or just after you have finished return on capital employed for 2008, do for 2009 also at that same time. This is the best, this is the technique that you should do. Ratios, any type of ratios, when you're doing a ratio, for example, you have to calculate 3 ratios for 2 years. So you are not doing one ratio for one whole year and then again starting the same process with the second year. No. When you're doing gross profit margin, do for both the years at the same time, then go to operating profit margin, then go to return on capital employed. Because when you're doing it like this, when you have calculated it, you know what you have calculated. So in your mind, you have already started comparing. Okay, you know, okay, this is better. So when you know in your mind this is better, automatically you know what you need to write in your discussion part. Okay, I can challenge you on this. If you have been doing it, try to do this and see. Automatically the points will come in your mind, even though you didn't write it yet, but you know what to write. Once you have calculated, the points will come. You know, okay, this is lower, so I should. These are this blah blah the reasons. This saves you in your time also. Time management. Okay. So now liquidity and working capital. Under this current ratio, current assets divided by current liability is to 1. This is a ratio. This is not into percentage, not into 100. Okay. For example, for current assets divided by current liability, it could be anything. It could be 2 is to 1, 3 is to 1, 2.5, or it could be less than 1 also. But the ideal ratio is 2 is to 1. That means you will be having more current assets over your current liabilities. That means you can, with your current assets, you can pay your current liabilities. 2 is to 1. But if you're having too high ratio, for example 5 is to 1, that is also not good. That means you are lying, your current assets is idle, you're stocking too much. So that is also not good. And less than 1 is also not. For example, it is 0.5 is to 1, it's not good. That means you're unable to pay your current liabilities with the current assets. 1 is to 1 is also good. Okay, but this again, the ratio, sometimes even if it's 0.8 is to 1 or 0.5 is to 1, sometimes it might be good. It depends on the industry also. Industry to industry this changes. Okay, if they have given you some industry ratios and all, you can compare it with the industry ratio. But if they have not given, then less than 1 is not good. Okay, then inventory turnover period. So the formula is inventories divided by cost of sales into 365 days. Okay, whenever you have to take something for period, multiply by 365 days. Okay, here also we have the discussion part that you need to write is, if there is a high inventory turnover, what does it mean? That means lack of demand for the entity is good. High inventory turnover is not good. That means your inventory, so much inventory is being lying in your warehouse. You're not being able to sell your inventory. It's not good. Having high inventory turnover is not good. Lack of demand. That means you are having a lack of demand. No one is demanding your product. That's why it's lying on your warehouse. And if it's perishable goods and all, like some food or vegetables, it's perishable, right? Then it will become obsolete, and it might become damaged also, because some product you have to sell it in 2 or 3 days. You cannot keep it forever in your warehouse. Next, poor inventory control. Yes, high inventory turnover is a sign that you are having a poor inventory control. Okay, next, same, under the same category, receivable and payable. So receivable collection period, how long your debtors are taking to pay you, your customers are taking to pay you. Okay, so this is trade receivables divided by credit sales. Please, it is credit sales, not cash sales, because cash sales, you don't have to wait. When are you going to collect? At the same time, when you sold something, you're going to collect the cash from the customer. That you don't have to worry. But if it's a credit sale, you have to see how long your customers are taking. 30 days, 60 days, 90 days. Okay, the longer the time it is, it's not good for you. So trade receivable divided by credit sales again into 365 days, because period. I told you, whenever period, 365 days. And increase in receivable collection. If your receivable collection period increases, it's not a good sign. It means lack of credit control. You are not having a good credit control. This will lead to irrecoverable debt. That means at some point your customer will be cannot pay you back. So it becomes an irrecoverable debt for you. Payable collection period is also same. Here, how long you are taking to pay to your supplier. So trade payables divided by credit purchases. If you are not having the information for credit purchases, you can take the cost of sales also. Okay, into 365 days. A long credit period. Here, it is an advantage also, it's a disadvantage also. How it's an advantage? Because if you're having a long credit period, okay, that means you are taking longer to pay to your supplier. That means you are having the cash for a longer period in your hand, which you can use for other purposes. So it's a good sign. But again, the negative sign is that the longer you take to pay your supplier, there's a risk that the supplier is not happy with this. They might reduce or withdraw any credit facilities from you in the future. So you have to uh, evaluate and see whether the benefit is bigger or the risk is bigger, and then take an action and manage your these ratios and all. Okay. Now the third type is long financial stability, gearing. Gearing could be presented in two ways. It could be debt over equity or debt divided by debt plus equity. Okay, you can use any of this in your exam. Okay, examiner will not penalize you. Okay, so if you ask me which one is more correct, I will be unable to answer you this question. That's the reason they have given you both. So you just use any one of it. Highly geared entities is also not good. More than 50% is not good. Why? Because that means you are having a great financial risk, greater risk of insolvency. Because see, debt and all, no matter what, even if you're suffering a loss, you have to pay interest to your debt holders. So it's a risk, financial risk. You might become insolvent. Lot of bankruptcies and all happen because of this. They have taken a huge amount of debt, which they were after some point of time they were unable to pay back. Hence, they became insolvent, bankruptcy, closed down. Okay. What happened with Arthur Addison? It's the same reason. Unable to pay back their debt. Right? Interest cover is the second type of long financial stability, that is operating profit divided by finance cost. Finance cost means your interest. So operating profit will be given to you in your profit statement of profit and loss. Even your finance cost also will be given to you in the same statement only. So you can get the figure from there and put it, calculate it. Okay. Higher the interest cover, better it is. Okay. But a low interest cover is not good. Why? It means entity is having difficulty in paying back its interest from the operating profit. When your operating profit falls down, you will face a problem in order to pay back your interest. That is the meaning of low interest cover. But high interest cover is good. That means you will be able to pay your interest with the operating profit that you are getting. Okay. Now, the fourth type, the investor ratio, PE ratio. PE ratio is price earning ratio. Price divided by earnings. So current share price divided by EPS. Now do you see why EPS is important? So in your PE ratio, you need to know the understanding of earnings, price, share, EPS. You need it. So this divided by EPS is your PE ratio. Here also higher PE ratio is better. Okay. So what is PE ratio? What does it measure? This represents the market view of the future. Okay, higher PE ratio means that this is a positive sign. That means in the future, this company is going to make uh, higher returns. That is the meaning of higher PE ratio. It tells about the future of the company. Through this, you can predict the future of that company. It's a market view. Okay. Then high PE ratio suggests that growth is expected. Yes. If you're having a high PE ratio means this company is likely to grow in the future. That is the meaning of it. Okay. Don't put complicated words and try to use technical jargons and all and confuse yourself. No, just keep it very simple. When you're explaining ratios, also keep it very simple. High ratio means growth is expected, or low ratio means this is not likely to grow. This market is likely to decline in the future, hence you are not going to invest, hence you are going to sell your shares. So these are some recommendations you can give. Okay. Now the last ratio, earnings per share, already covered earlier in IS 33, not going to cover, but the summary is here. Basic EPS formula, diluted EPS formula, bonus issue and right issue formula you have to know. Okay. So that's it. Finally, we have completed financial ratios under analysis and interpretation, the first topic. The first and the second is EPS. I've covered both in one only. Okay. One test your understanding is here, only one, and that we are going to cover before I finish this video. Okay. So test your understanding one, Starling. Starling has issued B class shares and has recorded them as equity instruments in the statement of financial position. Under the terms of the shareholder agreement, Starling is obliged to redeem the shares in cash in 3 years' time. Okay, discuss the impact on the financial statements of the above error. Your answer should make reference to the financial statement ratio. So in your exam also, this is the type of question that you can expect in your SBR. Even though this is test to understanding is easier, but when you go through a revision kit questions, you will understand the type of question that can be asked better. You see, here they didn't ask you to calculate ratios. Here they just asked you discuss the impact of the error in the financial statements. And to discuss that, you have to make reference to the financial statement ratios. Okay. So what type of financial statements can you think of? Here, you don't have to talk about all the types of financial statement ratio. No, no, no. Profitability, liquidity, no. Don't need all those things. What type of ratios do you need? Looking at the share is recorded as equity. One is gearing ratio you can talk about. So investor type ratio, the fourth type of ratio you need to talk about, right? One is investor ratio, the other one is what? Under investor ratio, that is gearing and the interest cover. Okay. And so these are the ratios that you can talk about. Let's see the answer. Answer is very short. That's why I've copy pasted the answer. Okay. Because if it was some calculations and all, I would have written and shown you how to calculate. But this is just theory. But that's why I've just copy pasted it. Okay. So this financial instrument, first of all, you have to understand, is it correct or not to classify it as an equity instrument or no? If it's correct, then how it will affect the statement ratios? If it's not, then what are the changes that you need to make? So here, if you see the answer says this should have been classified as a financial liability, not an equity. Why? Because contractual obligation to transfer cash. To transfer cash, you just see, Starkling is obliged to redeem the shares in cash in 3 years' time. Whenever you have the word obligation, it's a financial liability. It's an indication that it's a financial liability, not equity. That's the reason. Obligation to transfer cash. That's the reason it's a financial liability. So now equity has to be classified as financial liability. Understood? So second paragraph says this means equity is overstated. These are the languages, these are the words you need to write your SBR answers also. Whenever this type of question is asked. For here, for this, you don't need the understanding of any standard. You don't have to apply any standard here. You need analysis and interpretation. Okay, but yes, the rule that you have used in the first line to say it's a financial liability comes from your IFRS 9. Okay, sorry, I think IS 32. So that you need. But mainly, that's not the main thing. Okay, this means starting equity is overstated. Why? Because you have put it as an equity. That means equity is overstated and liabilities are understated. So this error will improve what ratio? Gearing ratio. You see, you have to identify. They will not tell you calculate this ratio, this ratio, this ratio. Sometimes, yes, they will tell you how this ratio is affected, how this ratio is affected. But sometimes they will give you like this. Which ratio is affected? You need to identify. Here they're talking about equity and liability. So it's a gearing ratio, equity and debt. You understood, right? First is gearing ratio. There could be more ratios also, but sometimes it could be just one direct ratio that they're asking about. So here it's a gearing ratio. The gearing will improve. Sorry, this error that they have put as an equity rather than liability will improve the gearing ratio. Why? Equity will increase, debt will reduce. That's the reason. Gearing ratio will improve means gearing ratio will go down, which may lead investors to underestimate the financial risk. Because of this, what happens? See, what is the main reason why are we doing this analysis and interpretation? Go to the introduction. So that investors can take a decision, investment decision, whether they have to sell the shares, hold the shares, or what they have to do. So here, because of this incorrect information, looking at the gearing ratio, it's an incorrect ratio, right? They will underestimate the financial risk. Even though financial risk is greater here, they will think it's not a greater because gearing ratio has improved. You have understood now. So this will lead the investors to underestimate the financial risk. What the investors will financially do or how they will behave is what you actually need to write in SBR. That's the reason we are doing all this analysis and interpretation, all these topics we are covering. How the investors will react, what they will do. Third paragraph, dividends on equity instruments are charged to retain earnings. So this is the second type of your ratio that will affect dividend. One ratio, when you're talking about an impact in one ratio, you can use a separate paragraph. Second ratio, second paragraph. Okay, so you can divide it in different paragraphs when you're talking about multiple ratios depending on the number of ratios. For example, you might be talking one transaction or error could have impact on three separate ratios, so you can write it in three separate paragraphs. That's the most best way to do it rather than putting everything in one and becoming confused. Okay, so the last paragraph talks about dividends on equity instruments are charged to retain earnings. Because you have charged liability incorrectly as an equity, now dividend also will be there on that equity instrument. So where will that dividend go? Retain earnings. It will charge to retain earnings. Whereas interest on financial liabilities is charged to finance cost in the statement of profit and loss. Can you understand? That means financial liability will have interest. That interest will go where? Statement of profit or loss as a finance cost. So this means that sterling's profit and earnings per share. You see two things they're talking about. One is profitability, the other one is EPS, earnings per share, will also be overstated. Basically, you have to tell this ratio will be overstated or understated. That is the whole purpose of this, doing financial ratios. Sterling's profit and earnings per share will also be overstated. How? Profit will be overstated. Why? Because you were supposed to put interest in the finance cost in the statement of profit. Now you don't have that interest. That means your profit will go up. You are not deducting any interest. Rather, you are putting that dividend under retained earnings. So profit will go up. How earnings per share will be overstated? Because your shares, your earnings, first of all, your profit. Your profit is only your earnings. Earnings per share is earnings divided by number of shares. So earnings increased because profit and earning is the same thing. Okay, profit increase means earning also increase. So your numerator is increasing. Share is increasing too. Okay, so earnings per share will increase because if your profit EPS increases, will also be overstated. Can you see? This also everything is overstated. Equity is overstated, profit is overstated, EPS is overstated. But your this one is understated, your liabilities. Okay. So I hope with this now you have a clear understanding of how to apply the knowledge of financial ratios into your SBR question. This is just one way. There are many ways of writing, doing questions on financial ratios and also other types of ratios and other non-financial factors that we are going to cover in the upcoming video. Okay, so today we have covered the important thing financial ratios, and next video we'll be covering impact of policies and estimate. Again, this comes under analysis of interpretation, analysis and interpretation only. It's not a separate topics. Okay, so thanks for watching and I will see you in the next video.